All right, we're live.
All right, we're live, ladies and gentlemen. Welcome, everybody. All right, so what happens if stocks fall, bonds don't rally, and commodity prices rise? The answer is it's a real ugly for most investors. 60-40 is an all-in bet on disinflationary strong growth. How prepared is your portfolio if we have inflationary weakness? This is going to be one of the many topics that we're going to address today. This is a recent tweet by our guest, Bob Elliott, CEO of Unlimited Funds. We're going to get to his thoughts on the tweet, many other things. But before we get into it, just a little bit of housekeeping. We're going to talk about all of these topics, and we're going to give kind of some high level understanding of what's going on. But ultimately, everybody here is trying to help everybody out there. And for example, Bob runs an exchange traded fund. HFND is the ticker. Unlimited multi-strategy return tracker, ETF. And this is kind of the things that you're going to need to be looking for, right? Non-correlated return streams that are very different from your traditional equities and bonds. And so if you like that, do go check Bob's funds out at unlimitedfunds.com. From the perspective of Resolve, go to investorsolve.com. We have a wide variety of solutions there, from private pools to public funds to separately managed accounts, including the Return Stack series. So please do check us out. And now we can get right into it, get Bob's thoughts. Let's go.
And before we do, let's just remind everyone that nothing we discuss here today should be considered investment advice. This conversation is for entertainment, hopefully, but definitely informational purposes. So with that, we kick it over to Bob. How you doing, Bob?
Hey, how's it going, folks? Good to see y'all.
Yeah, welcome. It's this is actually a really timely occasion, right? I mean, we just had the Fed announce and comment, and they seem to have caught markets off guard again. Any surprises in Jay Powell's talk, or in their policy actions, or in the so-called dot plots?
Yeah, I mean, it's not just the Fed. I like to think that we had sort of a central bank bonanza that we're all recovering from, right, over the last 10 days. Where we got ECB, BOJ, BOE, Bank of Canada, Fed, plus the Nordics and a few odds and ends in addition. And I think when I scan across basically all of those central banks, I think nearly all those banks are basically at a point where they're saying that they've done enough, that they're not particularly urgently moving to additional tightening. They're much more focused on a wait and see approach. And I think that's particularly interesting in the context that none of them are even close to achieving their inflation mandates, right? Basically, all of them need, in one way or another, are supposed to deliver 2% inflation. And take the ECB, they're stopping their hikes at 4%, and inflation is between 5 and 6. It's not like. And it's been stable that way basically, for a while. Take the BOE. Core inflation has been stable at 6% for 12 or 15 months. And they're stopping their hiking cycle, right? And so the Fed is probably a little bit ahead of most others, but still pausing their hiking cycle when it's certainly not clear that inflation is definitely durably going back to their 2% mandate. And so
it seems to have been turning up lately, right? I mean,
if anything, right. And this has all occurred as oil prices are turning up and energy prices are turning up. And so you're getting, and a lot of that disinflationary impulse that really helped bring, basically took inflation from being at the high single digits to sort of the mid single digits. That's unwinding, right? There was a big disinflationary impulse. That's behind us, not ahead of us. And so you sort of add that all up, and I look at this market and I say to myself, well, is there a possibility that the bigger mistake these central banks will be making is that they stopped too early? Is that the biggest mistake and the thing we should be worried about, much more so than did they tighten a little too much, and are we going to get some economic weakness?
Yeah.
And so I think one of the
that inspired a lot of comments.
Oh my God, I can't wait. Everybody out of my way. Go ahead, Adam.
I was just wondering, if we were to compare this to the 60s, 70s, and maybe that's not the right analog, but, it does remind me in some ways of McChesney Martin in the late 60s, and he paused and he had a sort of mini panic because they did observe not just inflation gauges rolling over, but some credit gauges rolling over and other economic metrics. And so put the brakes on vastly too soon. And then, of course, we saw the real surge in inflation. And it's, we've seen UPS with just a massive increase in compensation for their drivers. We've got this UAW negotiation going on that's going to affect hundreds of thousands of auto workers. And these are just the ones that we see. Like, are we starting to now see dynamics become entrenched just as the Fed is becoming more sanguine that things are going to turn out okay?
Yeah, I mean, I like the 60s analogy because when you turn to the 70s, you got some of the issues with the, like oil prices went up 5x, like that's not happening right now. And that had a lot of it was after a period of 15 years where inflation was sort of let to run a little too hot for a little too long. And so I think the second half of the 60s and that 60s period is actually a good one. Income-driven expansion, not much credit orientation. Inflation remains a little too high for a little too long. And then, of course, an important recognition that I think connects well today is, you have, a foreign war that we're in part paying for, expansionary fiscal policy. At that time, it was both war-related policy as well as domestic spending. We have sort of a lot of the similarities there. And I think the key lesson at that point was, the Fed just didn't get ahead of the inflationary dynamic. They sort of were building off of obviously the very disinflationary 30s. And then even, the post-war period in the 50s was quite boring in that sense after we sort of resolved the post-war issues. And sort of the expectation was, well, this won't really be a big deal. We can run huge government budget deficits. We can run monetary policy that's not particularly tight in the face of, moderately rising inflation or elevated inflation, and it'll be okay. And then, it wasn't okay. And so I think that's actually a great analogy in terms of where we are right now. Less of a Burns moment and more like a 60s moment.
Yeah,
so
like
one of the
McChesney moment. Yeah. You and I should probably start pitching that on Twitter. See if we can get people to pick that up. It's a McChesney moment.
But really, it's interesting because the paper that the IMF came out with, the 100 stylized or the 100 inflation shocks, 7 stylized facts, does a good job of summarizing kind of the big moving parts here and the big issues that the Fed has, right? Which is, or any central bank, which is when to stop, what has happened historically when you stop too early. I know you tweeted about this, Bob. Like, what are your thoughts on using historical analogs, broadly speaking, where the central bank in Europe is, or in the UK is versus the US, and what mistakes are they making?
Well, look, what that paper shows, which, I think anytime you're looking at those circumstances, the value is not in like the precise numbers, right? The value is in understanding the linkages in terms of how things work. And the thing that I found the most interesting in that paper, the gist was that if you had inflation shock of some sort and you ran monetary policy like largely consistent with the Taylor rule in one form or another, you basically resolved your inflation problem, in relatively short order. And if you run monetary policy that is, more dovish than the Taylor rule, then, your inflation problem doesn't get resolved in the near term. And so, take a look at what the US and other central banks have done, like the fact that they were late to the game, all of that points to the fact that they did not run policy sufficiently tight in response to that shock. And, we're sort of paying the price for that right now, which is that, the inflation dynamic is a lot more entrenched than it would have been otherwise. I think the thing that is super interesting about that paper is that often people will say that there's a trade-off. You don't want to tighten too hard because you might slow growth, and that might cause, an economic weakness, an undesirable economic weakness. But the thing that paper actually shows is that if you run monetary policy consistent with the Taylor rule and you tighten relatively aggressively, your medium-term growth outcomes are actually better than if you tighten less than the Taylor rule and you let your inflation problem be unresolved. And so
that's what got me. That was what's really interesting about that, right? It's just counterintuitive.
Yeah, it is. It is. I mean, it's the thing that drives, the thing that drives medium to longer term growth outcomes is stability, right? Productivity benefits from stability. Stability, the biggest thing that undermines stability is inflation. And so in that sense, the sort of linkages that you see are relatively straightforward. And I think, there's just a lot of nervousness that, you might have a growth problem. The tightening might lead to a growth problem in sort of an immediate sense and not appreciating what that means over 5 or 10 years. What
do you make of the very substantial backup in rates after Powell announced? The bond market clearly was not taking a great deal of confidence in Powell's statement, right? And then they backed up again overnight, and now we're at or near new highs for the cycle. I think we're at new 15 or 18-year highs or something in the 10-year rate. Is the bond market saying that the Fed should not be done here? That in fact, long-term inflation risks are higher than the Fed is giving credit to?
Yeah. I mean, I feel like sort of speaking like an old man. I remember when bond yields were above 5. Holy crap, we've forgotten. like bond yields can be above 5. Like it's not
like a physical rule of the universe. Yeah.
Right. And like everything can be okay with bond yields above 5. Right. Like that. We had that. Not just like in our lifetimes, in our professional lifetimes, and not that long ago. I think the thing that you're basically seeing in terms of the dynamics in the bond market is, the worst, counterintuitively, the worst thing for bonds, long end duration today is the Fed stopping their hiking cycle, right? The best thing for bonds is the Fed hiking aggressively. And so that's basically what we're seeing is the Fed and other central banks have basically said, look, we're done on the hiking side. Like short rates aren't going any higher. And, we'll just wait this sucker out. And I think basically what people are starting to recognize is, okay, well, what that means in conjunction with the fact that we haven't gotten inflation back down durably, clearly durably to target, is that risk of long-term elevated inflation, the probabilities of that go up in that instance, which means that that bond yields are selling off. And of course, there's some flows issues related to U.S. bond yields. But in the short term, I think that's basically the market action that we're seeing is that very, very classic bear steepening in response to a central bank just not being tight enough in response to the underlying economic conditions.
And we saw follow through on that too, on the Japanese inflation numbers and the BOJ.
Yeah, I mean the BOJ. Japan's in a bit of a different circumstance. If anything, they could probably benefit from a little bit of inflation, and their inflation problem is more like in the 3 to 4 range versus if you look at Europe, you're in the 5 to 6. If you're in the UK, you're in the 6s and above. So the Japanese situation, like for the whole year, basically, I keep telling people like, look, yeah, sure, running capping rates at an extremely low level doesn't make much sense, which they mostly have dealt with. But like Bank of Japan is not going to get on the move in terms of tightening anytime soon. Like the economy is still depressed, inflationary. You still have a big hangover from decades of deflation. You still have that mindset in place. Inflation isn't nearly as high as in other economies. Like Japan's going to take this easy. And I think some people thought Ueda was going to come in and just totally wreck the place. And, that was a bad trade. And instead, he's just sort of cautiously, very, very modestly tightening a little bit in that economy, which is mostly what's appropriate for it. If inflation gets to 6 or 7%,
right? For the first time in decades. So, they're clearly acting. They're signaling that they're ready to act should inflation get uncomfortably high, but there's there's no reason to think that it is
but it's fine. 3% inflation in Japan.
Right. They've been,
it's good.
Probably what they needed.
Begging for
what they've been hoping
for, for decades.
That's right. Historically, they've been begging for. But to maybe double click on the U.S. for a second. So some of the estimates I saw, as per like the Taylor rule of where Fed fund rates should be right now, given all the other variables, would be somewhere in the 7.5% range. This seems to be, or at least he would want us to believe, that this is Powell 2.0, that this is not the pivot Powell of October 2018, that this is a new Powell that is very serious about inflation. All of his latest, like the Jackson Hole appearance and his short and focused speech said that his eye was still on the ball. Obviously, they know all the historical precedents. They know of the McChesnick or whatever the reference that you guys just used, or the Arthur Burns.
McChesney.
That's the gentleman. And so, given that they know all these historical precedents and they know and they can calculate the Taylor rule, what do you think is keeping them from actually moving? Is it just political expediency? I mean, they're de facto beholden, even though they have political, legal independence from government. At the end of the day, they continue to be an arm of the U.S. government.
No, I really strongly believe that there's not political in any like partisan or any sense related to that in terms of the Fed. I think, they're more controlled by like longer term great principles of life. Like Volcker often said, the threats to raising interest rates too high are always obvious, right? You're always concerned. It's always clearer. The concerns about tightening are always much clearer than the concerns about not tightening enough. And I think that's basically what they're experiencing. And I actually think it's this McChesney moment thing. I think I'm really like digging on that, because I think that actually is a really, really good corollary, that you have to think about how central banks fight inflationary periods as like a psychological dynamic. And they almost always behave in basically the same way, which is there's an inflation shock. They're behind the curve. They think it's transitory. They're behind the curve. They tighten a reasonable amount, but not quite enough because they're concerned about growth, right? And then they sort of do this interplay where they tighten a little bit more, and then that's not quite enough. Growth slows, and then they get a little worried, and they sort of go back and forth, and that creates this sort of inflation meandering up the curve over a period of time. And then at some point you get to a point where the destabilizing effects of the inflation become so acute that it's obvious, it becomes obvious to everyone that it makes sense to fight the inflation and not worry too much about growth, even though you know that it's going to be a growth problem. But to get to that point, it's, like it can take a very long time. And even the Volcker situation, I always like to remind people of this, like, Volcker fought inflation and then gave up 2 times before he finally succeeded in the span of 3 years. So like even Volcker, who's like the best, who had the biggest mandate to fight inflation, who goes down in central bank history as the greatest central banker in the history of time. Like, he also screwed it up a few times, right? Yeah, so that gives you a sense.
Yeah, he struck out twice, or he had two balls and finally hit it out of the ballpark in the third try. So to that, you may or may not be able to answer this question from our listeners. This is from Panoramic London. Where does Bob think the Fed funds should go to bring core PCE to the Fed's target at 2%? Now, before you do answer that, though, everybody that's listening here, Panoramic, everybody, please do, smash that like button, the subscribe button. It does help us bring amazing guests like Bob to our channel. And also don't forget that we do these type of things for educational purposes, but we also have a business. Bob has an amazing ETF at unlimitedetfs.com. If you want to visit us, you can go to investorsall.com. And I'll just address one thing that's been coming up quite a bit. I think, our public products and Bob's public products sometimes are seen as, very difficult to put into portfolio, to make some room in your portfolio in order to make it work. It feels like you're taking away from returns in equities and bonds. But as Bob alluded to in one of his previous tweets, if they have a similar Sharpe ratio long term, then you should not care. But if you do care about short-term underperformance, you, I think, would benefit from going into returnstacked.com. This is a kind of a dedicated website that talks about ways that you can create capital efficiency using public ETFs and mutual funds so that you can make room in your portfolio, keep your traditional core bond holdings, and then stack funds like Bob's funds on top, and of course, the things that we do. So please do check out any one of those websites, all of them. And now we can get back to a regularly scheduled programming. Panoramic London asking, where does Bob think Fed funds should go to bring core PCE to Fed target at 2%? What are your thoughts, Bob?
Yeah, well, I think the question, I won't try and dodge the question, because I think part of it is like, I probably wouldn't even think about Fed funds. Like, it's not that interesting at this point because the Fed's not going to bring Fed funds anywhere beyond where roughly it is today, or maybe 25 basis points more anytime in the near future. So it's like, the Fed's dead. So then let's talk about what actually has to happen to bring core PCE down, which is you have to have, the main issue is that there's too much wage growth. Wages in the US are growing at 5 to 6%. Productivity growth in the US is about 0. The same is basically true in Europe and the UK, where you have 0 productivity growth and wages that are growing at 5, 6, 7 in the UK, even 8%, depending on how you measure it. So that's really the gap, is too high a nominal wage growth relative to productivity growth. That creates structural inflation. And so how do you break that? Well, you've got to create easing in the labor markets. How do you create easing in the labor markets? Well, to do that, you've got to slow down demand relative to the capacity. Well, how do you slow down demand? Well, you got to get people to start saving more of their income and spending less of their income. And how do you do that? Well, you've got to get asset prices down to start changing that choice between spending and savings. And so the thing that's really going to create the durable decline to the 2% PCE rate is getting a meaningful turn in the cycle, which is going to require a shift in asset prices, not really short rates. Short rates aren't going to move much from here. It's really about the asset prices. And I was saying on Twitter yesterday, just kind of like trying to work through, where's the peak in bond yields look like and what's necessary to bring the cycle down. I think we're probably going to need bond yields into the 5s to get enough of an equity market softening to change, to start to create a tipping of the cycle down in that sort of self-reinforcing negative type dynamic. And how are we going to get that move in the bond yields? Well, it's going to be a market tightening. It's not going to be a Fed tightening. It's going to be a market tightening. And that's kind of how this is going to play out, is bear steepening, market-based tightening affecting asset prices. And that creates the dynamic to get us to bring inflation down.
I love that. That's the first time I've heard someone clearly say that there's the implicit target of the Fed is to lower asset prices in order to put pressure on household balance sheets, and I guess corporate balance sheets to a different kind of extent, to get people a little bit less enthusiastic about spending and more enthusiastic about saving. We know that we still have a lot of leftover residual in demand deposits from where government deposited funds directly into people's bank accounts to make up for lost income during the COVID lockdowns. And we continue to see deficits running in the 6-7% range. And according to the Congressional Budget Office, we're going to see 6 to 9% annual budget deficits, about as far as the eye can see. So, in the face of such a major fiscal tailwind, in your mind, does that mean that the Fed's job is even harder and they're going to have to get more aggressive, either with their QT operations, with higher rates or current rates for much longer than people expect, or maybe changing the composition of their QT, maybe shifting into selling mortgages outright or some other type of action in order to get markets to react to the extent that they need to in order to get the consumer less confident and less likely to spend?
Yeah, well, I think in a lot of ways, the Fed being dead also, it goes to short-term interest rates. It also goes to quantitative tightening. Like, I don't understand why the Fed seems to be like having a brain blockage about flexibly using quantitative tightening. Like, those of us who traded through the 2010s, like quantitative easing went up, it went down, like, like hundreds of billions of dollars on an annualized pace. We did twists, we did all sorts of innovative, interesting things that created flexibility when, interest rates were around zero, and the Fed needed that flexibility to implement monetary policy. And like, we get to today and it's like QT 95, that's it. Like, we're never going to talk about it again. It's just, it's like the problem we have today. I like to say we don't have a price of credit problem. Like, price of credit's gone up. People have stopped borrowing, but yet the economy continues to persist. We have an asset price problem. If you have an asset price problem, sell the assets, right? Yeah. Do something more in terms of selling the assets, but they won't do it. And I don't know why. And I think they're just like scared of some liquidity thing, and it's pretty bad. This is a real error on their part, not using that flexibly. But what it does do is it means that, in many ways, Janet Yellen is back in her old role. And the reason why I say that is because she controls duration supply these days. She can figure out whether there's going to be more or less duration supply. And she's essentially doing QT over the course of the next couple quarters in a way that the Fed, for whatever reason, isn't doing it. And so I think that's probably how this plays out, a combination of sort of just generalized market-based tightening and then Janet Yellen increasing duration supply from the Treasury is going to create that pressure on bond prices and on asset prices and create that turn in the cycle. And that's kind of, we've seen a little bit of it, and it's hard, these flows from the Treasury are going to be so big that, that it's going to be, you're going to actually have to see the flows to impact the price. No one can front run the magnitude of this in the same way no one could really front run QE when it started. No one can really front run this. And I was reading a tweet earlier today where someone mentioned, talking to a big bond CIO, and he said, there's just too many bonds coming. There's all these bonds. They just keep coming. I can't buy all these bonds. They just keep coming. And I think that's basically, that's where we're at right now.
So is the Treasury providing cover for the Fed in any way? Like, Bob, do you think that there's coordinated action taking place here? And could you see the Treasury trying to provide cover to some degree? The Fed has played bad cop for a while. Now there's a change in the preference for duration. Is there a chance, because she sat in that seat and because we have heard central banks clamoring for more help from Fiscal for so many years, is Fiscal finally heeding the calls?
Well, I mean, duration supply is picking up mostly because the Treasury is constrained in terms of their ability to not supply duration. And so, I think
cover.
I mean, is it providing? I don't know. I don't think there's much coordination
about that, though, Bob. What do you mean the Treasury is constrained in their ability to not supply duration? Why couldn't they substantially alter the mix of bills versus coupon issuance?
Yeah. So, I mean, the first thing is they didn't supply duration because we were at the debt ceiling, right? So, I mean, we were legally required not to supply duration, and then what happened was, they drew down the TGA and then refilled it with the bill issuance. But now at this point, bills are basically at the it's not a statutory decision. It's a strategic decision in terms of, bills shouldn't be more than 22% or whatever the number is.
Right. The long-term sort of historical precedent.
Yeah. The long-term guidance that exists from the technocrats in terms of the composition of the debt market. And so that's really what's happening here, is that the government's running, meaningful deficits. They've basically hit their cap on bills. And so now they basically have to issue the duration. And so in some ways, like, I don't know what to call it, it's lucky that that this is how it's worked out, but it is fortuitous that at a time when we still need some asset price weakness in order to achieve the overall economic mandate of the Fed, the Treasury happens to be supplying it. I mean, the frank reality is I bet the Fed would have preferred that the Treasury supplied this duration a year ago and tightened up things, a year earlier, so
Why
inflation
wouldn't the
wasn't as
Treasury
entrenched.
also have preferred this, given that they would have been issuing duration at rates that were 2 or 3% below? If you're able to issue 10 or 20-year maturities at 2 or 3 percentage points lower, that adds up dramatically too in terms of fiscal accruals, right? So, it seems like they had an opportunity a year and a half ago to issue a lot more duration at much lower rates, and at a time when that duration would have been really helpful because it would have further lowered asset prices and probably bolstered the Fed's actions as they're trying to fight inflation. It seems like a day late and a dollar short now.
Well, yeah,
they're out of sync.
What's the real thing? Like there was a time when interest rates were at zero for 10 years, and we would have done a lot better borrowing. This is like the Larry Summers argument, which I always thought was compelling, which is like, if interest rates are at zero, like borrow till the cows come home and just build all sorts of productive capacity and infrastructure and all that in the economy. And instead, this is like the road outside my house. They're like basically doing some sort of meaningless cosmetic set of work related to the infrastructure bill. And, at a time when the unemployment rate is like 3.5%, like, why are we building roads when the unemployment rate is 3.5%? Like, what an incredible waste. But that's how at some level, that's how the government works. And, I think what I'd say is, maybe not that's how the government works. I think we have transitioned, which is why I think the 60s is a good corollary to a world where we have more proactive fiscal policy than reactive fiscal policy. Those of us, who grew up in the 90s and the 2000s, in terms of thinking about these things, fiscal policy was essentially responsive to what was going on rather than and cushioning it rather than proactive. But we have now, a proactive, like, second half of the 60s style fiscal policy environment, where you sort of have to think about fiscal policy as a proactive force in the overall economy and markets in a way that really, until this year, you hadn't had to. It's kind of a rant about zero interest rates and investment, but there you go.
Yeah.
Oriented
signals are not indicating that investors are starting to wake up to the potential for a much more sustained inflationary impulse, right? You've got the bond market. The bond market seems, at least, nominal rates seem to be accelerating maybe in the recognition, but we still see long-term inflation market-based long-term inflation expectations stuck around that sort of high 2, very low 3 range. What's it going to take to see those expectations budge?
The market, and particularly, let's say, long only bond managers, it feels a lot like 2011. Now, I don't know, 2010, 2011. I don't know how acutely that is in your mind, but the reason why I say that is at that time, obviously we're having a deleveraging environment, which was different from a more traditional cyclical environment. But nonetheless, you had basically V-shaped recovery keep getting priced in to the short rate market, right? It's like, actually, the greatest trade of all time was like long bonds against that V-shaped recovery, because we essentially had an L recovery, for a really long time, right? For 10 years. And so it feels a lot like that, which is like, at that time, investors in their whole careers had only known basically cyclical down, cyclical up, cyclical down, cyclical up. In the same way, sort of bond investors today kind of only know 2% inflation, right? They only know sort of a negative correlation between stocks and bonds and a 2% inflation number. Sometimes, people ask me why is breaking inflation just stuck at 2%? And I say to them, well, I think the answer is that the modelers just typed in 2% and hard coded the number in the Excel. Like, they forgot that it could possibly be different.
No, let's pull on that thread.
Actually.
Yeah, no, let's pull on that thread on the tips, because you hear these commentators talking about how tips have, quite a low predictive power historically for actual inflation, and it really is just a non-arbitrage relationship. And so, do you subscribe to that? Do you find tips a compelling way to forecast inflation, or are you on the camp that tips are just another instrument and variable to gauge what currently would be the break even, but not necessarily a strong predictive variable for forecasting inflation?
Yeah, I mean, I wouldn't use tips and break even inflation implied by tips to forecast inflation, like at all. It's an asset market. It's a tradable asset market, and you can start to think about what drives those assets and what's priced in. It's very useful to understand what's priced in. That's very, very useful to do that, and you could trade against it in the same way. You wouldn't necessarily rely too much on the short rate curve to tell you exactly what was going to happen to monetary policy, because certainly you wouldn't in the last 18 months. Because I mean, how many times is the short rate curve going to think that there's going to be 400 to 600 basis, 400 basis points of cuts and then get disappointed? I mean, you'd think like a toddler would learn after 2 or 3 times of this that their expectations haven't come true. But now, I guess those short rate traders still think that still keep hoping for the cuts to come along.
It's a misinterpretation of these variables, right? If you think about it, that there's a liquidity component to tips, and that signaling mechanism was broken to some degree, to the extent that tips became target of QE at one point and became part of the Fed's balance sheet. But so when you look across the asset class landscape, what do you think are the most egregiously mispriced asset classes versus your expectations for inflation? So maybe bonds are starting to catch up. Do you think equities are catching up? They've been selling off for a couple of days, but they seem to be still, pretty high versus other historical periods with inflation. And then if you can bleed into the a commentary around commodities, if that makes sense.
Yeah, I think right. Well, I was going to say, I think if you look across assets, where are the biggest mispricings? Well, I think we've got, we still have a meaningful, a very low term premium, something I was writing about yesterday. And, we're probably still 100-ish basis points below what sort of even like kind of a normal-ish term premium is that we should expect along bonds. And that term premium, it's very important because it kind of affects everything. Like, it's the reason why 5-year tips look better than 30-year tips. It's the reason why, bills look better than 10-year bonds. And frankly, it's part of the reason why equities don't look that great relative to cash, is because that term premium exists in all financial assets. And so term premium doesn't seem right. We still, we've moved to some extent off the bottoms, but there's still, I think, probably a ways to go on that. And particularly, like, that intersects with the flows dynamic related to the supply of bonds, because it's one thing if this bond supply is constrained with a low term premium that you can keep clearing the market at that price. But the problem is, if you're trying to issue a whole bunch of bonds when the value essentially is very poor, like, how do you get the next, the guy who stuffed IR Impossible? It was the Ackman tweet from earlier today. Like, the long only bond manager is stuffed to the gills with bonds. So how do you get people like you, like the 4 of us? When are you going to buy bonds? Right? Yeah. I'm not interested in buying bonds now, but I'm going to need to buy bonds. If they're 5.5, I'm certainly interested in the market. Anyway, that's a long. I've meandered off your original question, which I can get back to.
No. I do want to take this step by step, because I think a lot of the times when people who follow you and Bridgewater and everybody that looks at markets and then what's priced in, they don't understand how you price things, right? Like, what do you mean it's not priced in? There's a price that's out in the market that's supposed to be correct, and there's the price that I believe to be true. So you mentioned a couple of interesting things. You said term doesn't seem right. So let me try to translate, and then you can tell me where I'm wrong. When you say that, you mean like relative to history, the price of like term premium should be X, and right now it's X minus that, and we need to get back up to that long-term average. Am I right in the first assertion?
Yeah. The basic
simple observation like that.
Right. The basic point, just think about it very simply. Like there is cash has no risk. Lending your money out has risk, even against a person, an entity that will for sure pay you back. Right. There's interest rate risk. And so in order to do that, and you're parting with your money for some period of time, right? And so you'd expect to get more in the future than you get today if you part with your money and you lend it to somebody. Yeah. That at some level that's a very simple observation, yeah. But what that means is, okay, so how does that work? The yield that you're getting on cash necessarily is lower than the yield that you should get on instruments, because you'd expect to get a higher yield to incentivize you to lend out your cash for that term. Now, of course, you have to think about that in the context of what is the expected path of cash relative to those long interest rates. And so it's not just like literally the yield curve defines what that looks like. But if you start to think about like, okay, well, we expect maybe a very modest easing of monetary policy, so the expected forward yield of cash is still pretty elevated, frankly. And then what you look at is those bond yields that are trading at 100 basis points below cash. You start to say to yourself, well, it's what am I getting for giving my money for 10 years? And the answer is not much. In fact, maybe even negative, a negative return still at this point.
Okay, and so let me no.
I just want to qualify.
I just want to make sure I understand. So you have that's one thing, right? That's the differential, and now we also have the added element of there's a bunch of supply coming in from the Treasury and other places, right? So like, there's one thing to say it's undervalued. Equity markets have been overvalued for a decade. The other thing is, when is there going to be a catalyst in order for that to turn around?
Right. And that really, what it comes down to is there's value, which really, if you think about term premium, that's a value concept. And then there's, supply and demand at any one moment. And so you have to think about who are the buyers and who are the sellers at that any one moment, and also start to think about not just their incremental buying and selling, but their balance sheets. And so if you're a long only, if you're a pension fund or an endowment or stuff like that, and you went hog wild for those 350 yields that were being offered earlier in this year, like you've, not only have you probably gotten your fill on how many bonds you're holding, but also you're a little burned by that, by having lost, 10 to 15% on that trade. And so, you're starting to okay, so then who are the folks who are going to come in and buy the bonds? Like, I know that sounds like such a simple point, but it's like, where are the people that buy the bonds? Like, if you look back in the last 10 years, who bought the bonds? The Fed, well, they're selling now. Foreign central banks, well, they're selling now. Big, large money, long dated, pension funds, real money type accounts, well, they're stuffed to the gills with bonds. Like, who is going to buy the bonds? Like, that's the question. And the answer is, it's tough to find the person who's going to buy the bonds. And the way that gets resolved is just through a repricing. Right? You just reprice
financial repression, right? Which is the Russell Napier's hypothesis that we are going to live through a period of financial repression like we had in the early to mid 20th century, and financial institutions are going to be required to own more bonds, whether it's insurance and reinsurance companies, regulation shifts in order to provide cover for government. So I wouldn't be surprised, but I did want to kind of,
but the way that it's important to recognize on that. Also, IR Impossible, thank you for your running commentary. Also, banks were buying bonds, got burned by it, and have been forced to reduce their duration, not increase their duration, in order to reduce their regulatory, the regulatory risk that they have on their balance sheet. So they're not buying bonds anytime soon. I think the most important thing when you think about that story, which is financial repression, sure, but not that useful to trade markets. Not that useful to trade markets. I'll tell you why that is because there's an ordering of financial repression, right? It's like folks who say, well, eventually the Fed's going to have to print. Yeah, sure. Eventually the Fed's going to have to print. But how are we going to get to a point where the Fed has to print? First, the yields rise. Then the economy then asset prices suffer. Then the economy suffers. then those interest rates are unacceptable and there's steps taken to bring those interest rates down. But the ordering matters a ton, right? Don't get caught thinking that a recession, sure, I bet a recession will happen in the next 2 years. Almost for certain, there will be an Ember, marked recession in the next 2 years. But that doesn't mean this is the time to buy bonds, because first the yields have to rise, then the assets prices fall, then it becomes interesting to buy bonds. That's the ordering. And so repression, sure, maybe it'll come someday. I don't, in the life of a trader who's trading in a sort of 2, 3, 4, 5, 6 month time frame, I don't really care. Like, we'll get to that point when we get to that.
Yeah. But to get a little bit of more clarity, Adam, I just want to clarify, when you talk about a mispricing across the U.S. Treasury term structure of 100 basis points, that's on average. So I guess, is that a growing mispricing the longer you go out on that duration curve? So it's mispriced maybe 30 to 50 basis points on the shorter end, and then that mispricing grows, obviously because of reinvestment risk and duration risk and that sort of thing as you go out on the term structure. Is that an accurate depiction? Well, would you say it's a relatively homogeneous across the curve?
I mean, the real uncertainty. Now we're going to get into some of the nooks and crannies of bond market mechanics or whatever. But like the real uncertainty in the bond market that anyone really trades on is within the first 10 years. Like, what's going to be the interest rate, the 10-year interest rate 20 years forward. Like, no one knows, and no one's really changing their view on it, right? Because there's no reason to change the view on it. And so really all of the bond market dynamics, price dynamics, even out on the long end, are really mostly driven by what's happening in those first 10 years. And so that's why, like, you could get overcomplicated. Like, look at the 10-year term premium. It's close enough. It's basically the thing that matters to the bond market. And that's the thing that's basically, right now it's like 0 when it should be like at least 100 basis points.
Gotcha.
Fair enough.
Now I lost what I had something.
Okay, well, I have a question that it kind of ties into what we were discussing last week with PJ Pierre, which is the contention from, like, I think he comes from the school of modern monetary theory, Warren Mosler, and one of the things that he said was that one of the major reasons that might be driving inflation is the fact that we're increasing interest rates, because we're getting to a point where the money coming into the economy from savings of those interest rates are much larger than the expenses of the economy. And so, this was the first time I've heard something like this. It was an interesting point. What are your thoughts on that thesis, on that approach? That in fact, the Fed raising rates is a bad idea. That rates don't matter, and raising rates will mean, more savings, more spending, more inflation.
Yeah, well, I think there's sort of like, you can sort of like think about that problem conceptually, and of course, to the extent that there's higher interest rates, debtors are paying creditors higher yields, higher income essentially, and that like core connection or linkage is true. But I think you've got to think about and really add up and quantify all those pieces to really understand what the incremental effect is. Like the way that interest rates affect the economy first is through the repricing of credit. And if you look at how that's transpired, this hasn't been an extreme credit cycle. For sure, it hasn't been a big credit cycle, nothing like, the dynamic in 2008 or whatever like that. But, you have seen credit slow from running at $1 trillion and a half a year to close to 0 now. Okay, well, that's a drag. And then you think about, those borrowers who are incrementally paying. So that's incremental borrowing has slowed. So do interest rates affect incremental borrowing? Like, yes, they affect incremental borrowing. It matters a fair amount. If you look at what's going on with the debtors, like on the margin, debtors are paying higher interest rates. It's taking a little bit of time because a lot of stuff was termed out and fixed rate and all that stuff. And what do you get there? Well, like essentially the way that works is that debtors typically have a higher marginal propensity to spend than do savers. And so while it's true, you might have you do have a transfer of higher payments from debtors to creditors, given the fact that the creditor's marginal propensity to spend is typically lower on the margin, even if it's a dollar for dollar transfer, that's a growth negative rather than a growth positive. That's the one outlier on that, of course, is the government, that essentially in the US case is unconstrained, right? Their spending is unrelated to their borrowing, which is an important fact to consider. And so there, I think you just want to quantify what's the government paying out in terms of incremental income. Who's it going to? The vast majority. The vast majority of entities that hold U.S. Treasuries are the Fed, foreign central banks, and real asset managers, right? Like pension funds, endowments, and stuff like that. What are they doing with the higher income? Nothing. Like, just to be very clear, nothing. They're buying more financial assets, and that's supporting the overall financial asset environment. But like, how many people are actually earning so much more income that it's meaningfully affecting their spending and economic behavior? And I think the answer is like, not really. And you have to weigh that against. I should also say the last thing is, of course, higher interest rates affect asset prices because they increase the discount rate that flows into all these asset prices, as we've seen in the last couple of days or whatever. And that hit to asset prices then affects spending behavior, savings rates, etc. And so you sort of add that all up. I have a hard time solving the simultaneous equations in a way that says that when I net that all out, it means that higher interest rates lead to more spending, not less spending. I guess it's possible. I'd have to think about how to construct all those pieces, but I don't. The quantities, the quantification of those different levers nets out still to pretty negative in my mind. And I think, as asset prices come down, will be even more negative than we've seen so far.
Well, the timing and the leverage in the economy matters a lot too, right? Like, it takes a while for the government's debt to roll up into higher interest rates, right? Most of the debt has some kind of term. You have to wait for those bonds to mature, and then they need to be reissued at higher rates, right? So it's not like those higher rates happen overnight. And also, the amount of debt in the economy matters, right? Like, back in the 1970s, the aggregate debt to GDP and the aggregate deficit to GDP was very small. We're now sort of nudging up against 100% debt to GDP, like just in terms of size of the deficit to GDP. And so, much higher rates on that amount of debt is going to have a larger impact on the economy than it would if the size of the deficit was lower. But I want to zero in on that specific point, which I haven't heard the MMT crowd talk about, which is, okay, great. The marginal propensity to spend on goods and services by the beneficiaries of these higher interest payments, which are typically insurance firms, pension funds, large
foreign central banks, and the Fed.
Central banks, exactly, is very small. So where does that money go? It has to go back into markets. So tying back to your point about the fact that a core factor in the slowing of the economy needs to be the lowering of asset prices in order for consumers to become less confident about their savings situation, and therefore shift some cash flows from spending into the savings pool. This is a dynamic that may increasingly affect the demand for assets relative to supply. So,
that's why it really comes down to this, to the long end, right? I think part of the issue is that we haven't gotten, like, the Fed being behind the curve has meant that that inflation, and if you think about stocks, right, like, what are stocks? They're basically nominal, it's nominal, variable nominal cash flows discounted by fixed nominal interest rates. And the problem is, because the Fed has been behind the curve, that nominal cash flow growth on the top of the equation has been growing too fast relative to the shifts upward in the discount rate. And so the result is that even though rates have been rising, they just haven't been rising enough to offset that top line growth. And so that it's not precisely that way because stocks are down a little bit, but like the big picture sense is like, we in a traditional recessionary environment, what happens is the interest rates rise a lot relative to the incremental rise in the top line cash flows. And that's what creates the asset price hit. And you see that in the intermarket action. Like, why did, like bond yields go up 10 basis points, long end goes up 10 basis points yesterday. And what do you see? You see stocks go down, 200 basis points, and long duration stocks are even worse. Like that's how you get this resolved quickly, is not by sort of persistently being behind the curve, but those rates start to move ahead of the curve faster than that income growth happens, and that then creates a circumstance where you start to see the asset price declines, and that's kind of been the problem.
We see that happen in the short term. We saw that back in 22, and it was a little bit more sustained. But in 2023, we've continued to see a major, like rates are substantially higher today than they were at the end of 2022, but so are equity prices, right? So we aren't seeing that effect be sustained in the equity market, right? The equity market continues to say fiscal policy is way more stimulative. Nominal growth is way higher and more sustainable than people expect. And so I'm going to price higher earnings out a lot further, and that's going to cause me to raise my multiples, right? And obviously there's just enough supply of liquidity to create that demand for equities, right?
Yeah, well, I think a big part of that in that equation is typically in a credit driven cycle, the rise in interest rates would cause credit to compress so significantly that it would create a drag on spending. And this cycle, we have something very different, which was initially a government transfer driven and then an income driven cycle, which means, like, if you think about it, income growth for lower quartiles is growing at 6, 7, 8%. Interest rates have not risen that much relative to 6, 7, 8% income growth. And so that's the basic problem, is the income growth, the nominal income growth is too high. And that's what's now financing the situation. Like, I understand that the government is running a reasonable deficit, but its impactfulness mostly occurred when it created a bunch of fiscal transfers to help bridge the gap to basically cushion the gap between the inflationary impulse and the point in which income growth could catch up. But today, there's no government transfers. Like, where are the government transfers? They don't exist.
There's a massive investment, through the Inflation Reduction Act, and we're investing in a bunch of infrastructure projects, demanding lower and medium skilled workers. You're talking about the guys on the side of the road who are, fixing the storm drains or whatever. These are typically, blue collar. They're not necessarily bottom decile, but they're, these workers have very high propensity to spend, right? So, these are the recipients of the kinds of stimulus that the government is currently engaged in. Yes, it's not as direct as the fiscal transfers we saw during COVID, but it's still hitting the, going to take that extra income and use it to either, pay down debt, or, which we know they're not doing because we've seen, savings rates collapse, or turn around and consume, right? To your point about the fact that it's an income-led consumption boom, and part of that income-led consumption boom is being funded by fiscal outlays for investment. Arguably really good, smart policy, right? Investing in at least some subsectors of sustainable, higher productivity capital, right? But it's having this effect.
Yeah, it's just I agree with you that the government doing that marginally is supporting this expansion, but the government is not the driver of the expansion. It's not the primary driver of the expansion. The primary driver of the expansion is continued elevated nominal demand from households, nominal consumption demand. And that nominal consumption demand is coming from private sector wage growth that continues to be very elevated. And like, that's the core. And I think one of the challenges is I think the one of the biggest challenges that people have, like sort of people who traditional sort of macro folks, is like they're sort of pulling their hair out. Like, how can that work? Like the government, the deficit is actually is elevated, but has compressed basically. Once you look through the seasonal factors and the California thing or whatever, like, it's lower than it was 3 years ago, right? The deficit is smaller today than it was 3 years ago. Okay. Money supply has gone down, right? Interest rates have gone up. Credit has compressed. Now, hold on a minute. Like fiscal policy is tighter than it was before. It's still level-wise loose, but fiscal policy is tighter than it was before. Money supply is contracting, interest rates are rising, and credit is contracting. And nonetheless, we get nominal growth of 4%, 5%, 6%. Now, how is that possible? Like, it goes against every linkage that we've learned over the course of the last 20 years in terms of what drives how these things work. And the simple answer, which is a hard answer for people to understand, is that it's income growth. And how is income growth happening? It's happening from velocity. Velocity? What the heck is velocity? like velocity we thought was dead, like buried into the ground. But it's a real thing. It's a real thing that you can have all of these measures of money contract and nonetheless have nominal demand expand simply by everyone agreeing with each other that they're just going to pay each other more. And if you had lived through many emerging market debt crises and inflationary experiences, this would be a very familiar story. It's like, well, how does it work? Like, I don't know, interest rates go to the moon, but nonetheless, inflation persists because we just hand the money to each other faster and faster and faster because we don't want it in our pocket. We're not obviously having Turkish-like inflation here, but or Argentinian-like inflation, but the essence of that linkage is how this works. And that dynamic is very similar to how expansions work back in the 50s and 60s. And that's why those periods are so interesting to think about when you're thinking about the dynamics and the linkages that are going on right now. They're really the things to study because those were income-driven, velocity paid for economic expansions. It's just, anyone who's seen that before is dead.
The way that the economy is traditionally supposed to work. Right? This is the actual economy that we set out to build, where you've got workers who earn a decent wage, feel confident, and therefore willing to spend, build a life, buy a home, start a family, right? This is the sort of positive feedback mechanism that creates a middle class and global prosperity that we haven't really seen in the last two cycles at all, right? So I think that's why.
Right. But that's assuming that the wages that they are getting are above the rate of inflation, right? Because at the end of the day,
that doesn't matter. That doesn't matter because growth is a nominal concept. Inflation is a nominal concept.
But their standard of living doesn't get better, is my point.
Sure, but that's not the conversation we're having.
Adam's presenting it as this is the dream, this is that, but it doesn't actually lead to a better outcome. For
sustainable prosperity, yes. You do need incomes that's effectively productivity, right? You've got
that is productivity. That's exactly right.
And inflation.
You're talking about wage price spiral, like in essence. But what's interesting about this case,
not a spiral, and I think that's an important thing. Not a spiral, right?
Well, a dynamic that could, at the limit, become a spiral. Right now, it doesn't have such a pernicious element to it.
It just reinforces itself, right?
Yeah,
and part of the thing, like if you go study, and the reason why this is so familiar to me is if you go study sort of classic toy economies. I highly recommend everyone read the economic principles or the economic organization of a POW camp. 12 pages, literally that document. The only things you need to know about macro, everything you need to know about macro and how economies work. 12 pages, promise you, it's worth
What is it again? Say that one more time.
The economic organization of a POW camp. Okay. And I think it's such a good toy economy. And what do you see in those circumstances is you see these sorts of dynamics where income growth can be funded through velocity. So they had cigarettes as their money because that's what came in the IMF packages. And then what would happen is the cigarettes would come in. Obviously, there was a deflationary force because people smoked the cigarettes. But nonetheless, you could have increasing economic activity because, one guy creates the tea and one guy is the coffee guy, the barista before there was a Starbucks, and one guy cuts the hair and one guy does these various things. That economic activity can expand in an environment where you have a contracting money supply, a contracting volume of money. You can have an increasing output because the money just travels faster, right? Even though it has a deflationary force in the money supply as the stuff gets smoked,
because
you can have increasing.
Happy to have less cigarettes in their pocket,
and they just hand them faster. They just hand them faster, and it's like actually not that big a deal.
Right.
And that's what we're seeing.
Clearly, I'm not smart enough to understand how this doesn't make everybody worse off. You got less cigarettes, you work harder, you're making more transactions, you have more output, you're getting less cigarettes. In this case, you are creating nominal wage growth, but is real growth happening anyway?
You're missing the temporal aspect of it, is because with increasing velocity, like just think about it, instead of getting, let's just say like a shave once a week, I can then get a shave once a day. Right? And that's how you're better off in that environment.
You're better off in terms of your consumption. You're not better off in terms of your wealth. Right? You're spending down your savings.
We're not no, because your income grows as well.
Your income's getting higher. You're not saving it.
Your income's getting higher.
Income going higher.
Yeah, your income's getting higher, but your total aggregate savings is going down, and you're willing to live with lower savings because you've got greater confidence in the economy, and you're spending
in your wage growth, right? And you spend your wage growth.
When you say your lower savings, you mean your purchasing power is going down, but because your income's going higher, you can spend. Like, are you actually saying that the economy currently is getting higher wage growth, and they're spending even more out of pocket from their savings to live that life?
You don't need to have any savings, and I think this is your savings can stay. I guess if you think about the savings as the constrained amount of cigarettes in the economy, in a truly toy economy where where your money supply is your only savings element, it's like functionally true that the deflationary forces or the cigarettes getting smoked means that there's less literal physical savings, but you don't really care about what your literal physical savings is. What you care about is how much you can consume, right? And so if your income's going up, right, what you care about is the fact that your consumption can rise in that circumstance, right. Not the fact that there's only so many cigarettes that you can hold in your pocket because you're just moving them faster and faster.
Savings is higher because your expected income in the future is also higher. Right?
Exactly.
Yeah,
So it's why like in that particular toy economy, like savings there's other elements of it that connect to savings, but in that particular example that I'm giving, it's not savings isn't really the key element because consumption happens through the fact that sort of temporally over time you get more activity rather than have more in your pocket that you could plausibly demand into the future.
So moving forward the conversation, because so you have this.
Not what you were expecting to talk about here, was it?
No, this is really good.
You didn't have that on your bingo card.
I'm going to read that. It's going to be great. One of your tweets was that sentiment today feels very similar to mid-08. Many folks creating justifying narratives as to why the U.S. and global economy could navigate the period without a recession. Right, so maybe we can link that what you were discussing with this comment and what we can see in the future with regards to a recession and maybe the equity market. But before we do, everybody who's still hanging around, please do smash that like button. Make sure that you're subscribing to the channel and follow Bob here, Unlimited Bob, right? Bob Unlimited.
Bobby Unlimited, right there.
Bob E Unlimited on Twitter. But yeah, Bob, let's get into that part. Why does it feel that way, and what can we do? What can we do to kind of understand the impact of the economy in reality, the impact of the economy and maybe the stock market?
Yeah, so I think when you're trading financial markets, what you want to think about is what's priced in, And then what do you think is likely to transpire relative to what's priced in order to have a view on which assets look good and which assets look bad. And I think all too often people forget the priced in part of it because they think just, and the last 15 years haven't been that helpful because most people think on a momentum basis, right? They're like, well, I think growth is going to be strong, so things are going to look good, et cetera, et cetera. And I think we've sort of lost our touch of saying, okay, let's have the discipline, start with what's priced in. So let's talk about what's priced in right now. Like what's priced in today is 12% earnings growth in 2024 and 13% earnings growth in 2025. 25% earnings growth over the next 2 years. That's for the S&P 500. Okay, well, so that's what's priced in. Now, what's likely to transpire? Like 25% earnings growth coming off of what is a very late cycle environment and a significant amount of monetary tightening that's occurred is certainly would be an unusual outcome. Not an impossible outcome, but an unusual outcome. And remember, in order to be indifferent to stocks, you have to see that earnings growth not just like come in right at that 25% over the next 2 years, but it has to beat, right, in order to hold stocks in that environment. And so when I look at what's going on, I think we've gone to a point, I guess it sort of peaked about 8 weeks ago or so when I think it was right when that Atlanta Fed GDP now kept printing at 6%, and everyone's like, the U.S. economy will never slow down again. You know what I mean? It's never going to slow down again. There will, we had surveys of investors that said like 80% of investors said that there will be a no landing, soft landing type dynamic. And like, the possibility that we get no landing, soft landing is certainly not zero, but it's not 80%. And it's certainly the probability distribution in terms of that we get 25% earnings growth, maybe could happen, could be missing something, could be a shock that somehow is supportive, but like probably not. And so that's when you start to add things up. It's not, as an example, that the U.S. economy is like a disaster right now, or the global economy is a disaster. It's just everyone expects things to be so good that even like kind of blah, it will meaningfully disappoint expectations.
Right. Yeah. So can we shift to strategy and what people can do about this? Just broadly speaking, I mean, you come from Bridgewater, and we're big proponents of everything risk parity, but also the alpha portion, right? Which is an interesting addition to this concept of, okay, we have all these different cross currents. Is it going to be continuous growth? Is it going to be, are we going to break the back of inflation and create a disinflationary environment? Or are we going to have continuous inflation, at which point bonds and equities will go down together? Where does a role? So I can see a role for commodities, obviously, from a passive portfolio, from a do no harm portfolio, always be prepared, right? The all weather, the risk parity. Where does a multi-strat, like the hedge fund space, come in to play in this environment today? And, is it something that should be a dominant part of people's portfolios? Are we thinking about equal weight here? Should we equalize the risk across a well-diversified multi-strat, commodities, equities, and bonds? Like, how do you think about your portfolio in that regard? Aside from the trade.
Well, I think
100% cigarettes. That's what I got.
Yeah, I mean, the answer is find, one deflationary currency and go all in, right? No, that's ask Japan how that went. Not so great. No, so that's not. So this is what I'd say is if you look at, most investors.
Just when should I ask people to smash the like button until he comes back?
Smash. If they smash it twice, do they unlike?
Yeah, that's right. Don't smash it twice. Just smash it once.
I don't know.
Right, smash it an odd number of times if possible.
I was about to give the great insight into how to engage in portfolio construction in the internet.
I did that on purpose just to keep people
decided that was not okay. All right. Most investors are 60-40, one way or the other. And if you think about what a lot of people do all day is they like nitpick the 60 and nitpick the 40. Like, I don't know, do you like these bonds or these bonds? Like, do you like these cows or, you know, I don't know, dividend things, or I don't know. There's all these different stocks you could possibly buy, foreign, domestic, all this stuff. Like, none of that shit matters. Like, just to be clear, over a meeting, over any reasonable time frame, none of that shit matters.
Breach.
Okay. So let's start with that point, which is 95% of the attention goes to things that make no impact on your portfolio over any time frame that you care about as a saver. Okay, so then let's talk about the things that do actually make an impact. There's 3 things that can make an impact on your portfolio, a meaningful impact on your portfolio, if you hold 60-40. The first is gold. The second is diversified commodities, and the third is diversified alpha strategies. And you know, I'll say gold and commodities, relatively straightforward. Even 10% allocations to gold and 10% allocations to diversified commodities can radically change your portfolio's positioning when it comes to inflationary environments. And the reason why that is because those have nice convexity in the event that, you know, inflation remains elevated relative to expectations. Okay. And man, most of you would have preferred to have been holding some gold and commodities over the course of the last couple of years rather than holding purely 60-40. And I'll emphasize, when people talk to me about gold, you know, gold, I'm not like some crazy gold bug. Like, I'm an empiricist about this, right? Like, if you go back over the last 75 years in the US, or the last 50 years in the US, of all the 12-month periods where stocks are down over the last 50 years in the US, gold outperformed bonds in 60% of the instances. Okay, well, that, you know, you don't have to get too complicated about that. Like, yet no one holds gold, right? Everyone holds bonds as their diversifier to stocks. No one holds gold. It doesn't make any sense, right? At a minimum, you should hold them in equal proportion on a risk-weighted basis. Like, you know, 10%, close enough. Just get it done and improve your portfolio diversification. And just take a quick look at that chart between gold and bonds over the last 3 years. And man, you wish you would have been holding gold instead of bonds over the last 3 years if you're trying to diversify your equity exposure. So those are the main, you know, gold, commodities, straightforward, go out. There's lots of cheap, easy, efficient ways to go buy them.
Wait. You're missing private equity, private credit. Aren't those amazing diversifiers? That's what's mostly done.
No, those assets suck. And I'll tell you why they suck. They suck because they charge 700 basis points of fees, right? Like, what is going on? If you actually match the same time frame that you can get your cash flows out of venture and out of private equity, if you match time frames, right? Because if you invest in a venture fund, it's not like you can mark to market however you want, you know, at any quarter or days, who cares? Like, you can't get your money. So let's talk about 10-year time frames, right? Because that's the time frame that you get your money back. If you look at it on a 10-year time frame, venture as an example, if you look at it at a 10-year time frame, it hurts your Sharpe ratio. It hurts the Sharpe ratio of a 60-40 portfolio if accounted for on a 10-year time frame. Like, what a terrible asset. You're making these venture capitalists rich, paying them 700 basis points in fees, and you're hurting your portfolio. That is crazy that you would spend your time investing in it. Not to mention you can't get your money out, like the liquidity option.
Money, it's complicated, convoluted. There's obscurity. You don't know what the
fees are. I get it. That's why you put everything in private credit.
Oh, man.
But you're forgetting the volatility laundering benefit that you get from a behavioral aspect that people love to hold these assets. And why advisors and allocators love it is because the lack of mark-to-market and the illiquidity is actually not a discount, but rather a premium behaviorally.
Sure. Yeah. I mean, the question is, how much does it cost? You know, I'll tell you, at 700 basis points, I'll give you a different option. Just open your brokerage statement once a year, once every 5 years, right? And then you could save the 700 basis points that you're paying to make the private equity guys, wealthy. Like, that's a very efficient way to do it.
Have a capital call every 5 years that's large enough to fund your retirement.
Yeah, right. Dealing with all those cash.
I'm not going to convince anybody of any of this. So let's okay. You were at
so gold, commodities. Now let's talk about diversified alpha. Now I think alpha is very interesting because there's a lot of alpha opportunities that are out there, and like when you look at hedge fund managers as an example, there's lots of good hedge fund managers that produce alpha. And on average, the hedge fund industry has, before you start talking about fees, has returns that are better than stocks, half the volatility, a third of the drawdowns. Okay, that's a pretty good set of returns. And one of the things that's really interesting, so the question is not like, is alpha a good or bad thing? Alpha is clearly a good thing. The question is, how much do you pay for the alpha relative to how good the alpha is? And the problem with most alpha strategies is the managers basically take all the alpha for themselves, and you're not that much better off. And so if that's the case, if you can, if the alpha costs too much, then it could be there, but then it gets eaten away and the manager takes it all, and it's not worth putting in your portfolio. And so the truth of the matter is most investors would benefit from not even talking about alpha at all, because it's not going to make sense for them. But if you can access cheap, diversified alpha, that's when this starts to get interesting. And in particular, I think the thing that's very interesting that I've been thinking a lot about lately is, how do you think about creating balanced alpha, right? Because alphas emerge at different points in a cycle, different points in an economic cycle. There are different opportunities to generate alphas. And one of the challenges that many investors have is they might find a return stream like managed futures, which has nice, convexity to their overall asset portfolio. But in, 3/4 of periods, it kind of sucks as an investment strategy. And that's because in 3/4 of the periods, the circumstances are not consistent with generating meaningful alphas there. So how do you actually create an alpha portfolio that you can live with? How do you create the diversified alpha portfolio you can live with? And I think that's a really interesting question, which is, you can't do it if you're holding funds because they cost too much and because you can't agilely move between the alpha strategies as you move through the cycle. But as we increasingly get these alpha tools, these alpha indexing tools that exist, we could start to think about, how do you package those alpha indexing tools together? First, the outcomes are much more knowable because they're indexes rather than individual managers, which have huge dispersion. So the attributes of those alphas are much more understood. And then what you can do is you can start to put them together agilely. You can shift between them in a way that takes into consideration that there are certain times where certain alphas are more effective, and there are other times when other alphas are more effective. And that is that's the cutting edge, like that. And if you could put that in a portfolio, you could do a hell of a job for people.
Well, now you're talking about.
Ooh, I got some interest on this idea.
Bob, when you say funds, you mean private pools and hedge funds where you're getting monthly liquidity or quarterly liquidity, and that's why it's difficult to shift between one and the other. And what you mean by these indices is, you mean kind of indices that one can replicate and put into an ETF wrapper, like you've done. We've done a similar thing. Certainly anything replication, go to Bob's site. We've also done a paper called Peering Around Corners, how to replicate trend following managed futures, which is kind of, if you're interested in knowing how that game works, there's plenty of stuff out there. But I think what you're saying, Bob, is not only is it good to diversify across those alphas, are you also saying timing those alphas is interesting?
Timing those alphas.
In an equal
yeah.
Okay.
And I think there's two steps. The first step is, how do you create balanced alphas, which I think that is, because I think the challenge, I don't have to convince you guys that managed futures is a good asset to have, is a good alpha to have in your portfolio. The question is not, is it a good alpha or not? If you could, only look at your brokerage statement once every 10 years, it would be a great asset to just buy the asset, stick it in there, don't stress about it. The challenge with it is it underperforms for periods of time, right? And has underperformed for meaningful periods of time. So people, like insurance, give up on it right before it really pays out. And so you have to understand the behavioral aspects of these things. And so part of what you can do to help improve the behavioral aspect is by creating packages of alphas that are more reliable than, and what I call the sort of balanced alpha approach, which recognizes that, as an example, if you took, say, 25% macro, 25% managed futures, and then on the other side of that, sort of like a portfolio of of, equity long short and fixed income and emerging markets and stuff like that, and you put that you take that as a balanced alpha concept, right? That is much more reliable. It's about twice as reliable as like managed futures. And so it's the sort of package that could be much more, much easier for an advisor to deal with than just trying to slot in the managed futures. And you get a lot of the other portfolio diversification benefits and Sharpe ratio improvements that could come from that sort of thing.
Right. And by just again, point of clarity, when you say emerging market and all those other things, you mean long, short, market neutral type of alphas, not
could be. Yeah, it could be market neutral. Could have some beta in them. There's reasons why you might want beta in your alpha, because it's. Oh, now I caught his eye on that one. There's reasons why managers have some beta in their alpha, and the reason why that is because beta is positive expected value, and so if you're creating
timing beta is a form of alpha, right? If you think about it, so
well, they're not timing beta most of the time, though. From what I
even structural beta makes sense as a manager to increase performance reliability. The issue is if you look at like a mutual fund manager, it's like 90%, 95% beta and 5% alpha, but hedge funds have in general about 0.2-ish or 0.25-ish beta in their portfolios. And that's about what a good complementary return stream is, given the goodness of alphas, the goodness of betas, and trying to create a more consistent return stream.
I think what it addresses is your point of behavioral issues. By adding a little bit of beta into your alpha, it's like adding a little bit of sugar into your medicine, right? I mean, you should just have for medicine, but
right. It is a little more palatable, right?
Yeah, but it's not from a practical
perspective. No, you're done now. What are the things that has troubled me though over the last decade or so is the fact that hedge fund correlation to equities has increased substantially, even while the beta has gone down. And the reason for that is that the vol has also gone down, right? So beta is a combination of volatility and correlation. So you have low beta, even if you're 100% correlated with equities, you can still have a 0.2 beta if your vol is 20% of equity vol, right? So, I just think it's a point of observation, certainly, and something to think about, that when you're allocating to diversifiers, beta is not sufficient to determine whether you've got a good diversifier. Really what you're looking for is something that's going to add volatility to the portfolio in an orthogonal direction to all of the other sources of volatility in your portfolio, right? So, correlation and volatility and beta, all of these things matter, and you should be looking at all of them, right?
I totally agree with that.
Rolling correlation that varies over time, right? A rolling correlation that's not static, but rather that it's, if you draw the correlation against trend following, that it varies because you're drawing some of your returns from trend the same way that you're drawing some of your returns from equities, bonds, or commodities, or even currencies, right? So for a
same for equity long short, right? The good thing about market neutral is that, in theory, vast majority of the time, except when you've got these sort of weird liquidity shocks, by definition, they're going to have zero correlation to equities. There are some other strategies like that as well. You can do that with managed futures and other strategies too. But anyway, this opens up a whole can of worms.
No, but I
feel like we're gonna get to our third hour here on structuring alpha portfollios. For those of you who aren't too hammered already to.
Yeah, raise your glass. Just give me some beer emojis if you're still sticking around. Okay, so one of the things that I tweeted recently that there's too many individual investors, advisors, small pension plans, and small corporate plans that are dying to run their portfolios like the foundation,
the Yale endowment,
like the Yale endowment, right? Which is kind of really overweighting privates and really overweighting these obscure type of funds rather than taking
advantage of overweighting equity risk in general. Yeah,
which is all like, and so they're trying to replicate the endowment portfolio when in fact what the endowment portfolio lacks is mandate flexibility and portfolio agility, something that the average investor does have a lot of. And so the question is, given that the smaller investors have those two things, mandate flexibility and portfolio agility, if the behavioral aspect wasn't that big a deal, how should they be thinking about weighting their equities, their bonds, their commodities, and their alpha in an ideal way? Like, actually forget about the 60-40 and having to keep and giving 10% to alphas. Like, what is the ideal weighting across those things? If we just think about those as 4 buckets.
Yeah, well, I think it goes to basically how do you think about the influence or the baseline need of an investor, and that is, real spending power out into the future, in a way, growing that real spending power in the future in a way that doesn't have undue volatility. And so if you think about how do you put that together, from a beta portfolio perspective, it's probably no surprise to anyone that I'd probably start with like a risk parity type framework, because I think, that has good reason why you'd believe that it should be more diverse in terms of a different set of economic environments. I think its primary limitation is it's pretty inefficient, particularly environments where there's elevated inflation, which leads to tighter monetary policy than would otherwise be expected to occur. And so taking that risk parity and then tilting it towards diversifiers for elevated inflationary scenarios like commodities and gold, I think is really important, because the thing that ruins an investor is not, the thing that ruins an investor is your assets go down, inflation goes up, right? Like, that's the thing that really screws you. And if that's the thing that really screws you, then then you got to tilt towards inflation protection. And that is a big deal. Not only does everyone hold 60-40, like, it would be better if you got over to risk parity, but no, you have to go farther than that, right? Than risk parity. And then what you want to do on top of that, that's sort of your beta portfolio, your structural portfolio through time, et cetera. And then I think from there, my 2 thoughts would be, you want to put in some trend, structural exposure to trend. It doesn't have to be, a 236 asset, highly sophisticated, crazy type trend following strategy that, the most sophisticated managers are running. Like, you can take the 4 assets that we talked about and just run a 1x12, and it's probably good enough, and agilely try and move, or buy some of these ETFs that are great, right? Just buy the ETF, put 10% into it, 15% of your portfolio into it. Great. And then take the rest of that, to be clear, assuming that you can handle the fact, the behavioral aspect of it, that you'll stick with it through time. And to be clear, all of this, like holding gold, requires behavioral aspects, like how many, gold kind of sucked from 2012 to, 2002 or to 2022, 2021, right? Kind of sucked, but you had to stick it out because then you got the benefit relative to bonds more recently. So a little bit of trend helps you navigate, helps you get that sort of tactical allocation into the portfolio. And then I think a diversified or a balanced alpha, which, deserves, 15-20% of your portfolio, because you don't want to get overweight on alpha, because it might work, it might not work. And, beta is cheap and reliable and pretty certain, more certain. Alpha is typically a little more expensive and a little less certain. So, you don't want to get over your skis in terms of betting the farm on alpha. And so that's sort of like, you put that together and you have the possibility, like relative to 60-40, to meaningfully reduce your real drawdowns with a portfolio like that, and meaningfully improve your sort of Sharpe ratio over time. There's no reason why you can't have twice as good a Sharpe ratio and, half the real return drawdowns that you're expected to experience with 60-40.
That's awesome.
With some of those.
Thanks, Bob. That's it. Show's over.
We're done. Perfect. So the only thing I'll add to that, because what happens when we have that's exactly where I thought you would go, and where I think most investors just think, if they have the emotional fortitude to be different, So there's a few divergent personalities here, I'm sure, that might be able to attack that. But the real issue always becomes once you put those three things together, volatility collapses so much that it becomes such a boring portfolio that it's tough to stick to when you're seeing the S&P 500 and your neighbors having a 30% year, right? So I think when you create a much more diversified portfolio, you straighten out that equity line, you'll also oftentimes reduce the absolute volatility and possibly the absolute return momentarily relative to the things that you care about, right?
That's why I kind of I wrote this blog, Simple Investment Game Plan, which people can go see at unlimitedfunds.com, which, kind of is like my ideal portfolio for one with meaningful intestinal fortitude. But what I kind of like, if I'm talking to an advisor, I was talking to a bunch of advisors at Future Proof last week, what I like talking to them about is like, look, let's not get over our skis on how to do this. Like, let's do a couple simple things. 10% in gold, 10% in commodities, 10% in diversified alpha strategies. What do you get out of that? You can get a 50% improvement in your Sharpe ratio, a meaningful reduction in your drawdowns, a meaningful improvement in your real return risk that exists. And you're still over 90% correlated to 60-40 on a monthly basis. Like just do that. Because at least you're moving in the right direction and you don't have all the pure risk. There's better ways to do it. There's crazier ways to do it, right? But I totally get if you're just, you're advising, $100,000 clients in suburban Atlanta or something, that maybe you don't want to, to go all out away from the 60-40. You want to get something with a little less pure risk, and you can go a long way with doing relatively simple things to improve the allocation.
Yeah, and also just to finish this up, I think you're right. I think we need to ease people in. I also wanted people to know what the full jam looks like, and then ultimately the fact that now with the concept of return stacking, you can actually continue to get that alpha and beta return of your portfolio, but really stack a lot of these alphas on top of your portfolio. If you don't know what I mean, I'm not going to get into it now. Just kind of go check out, just type in return stacking, you'll be able to see it. But this is a kind of an exciting time where the issue of making a this or that decision is kind of moved away. Now we can make a bit more of yes and decisions, right? You can buy an ETF out there that is 50% equity, 100% equities, 100% bonds. You sell 10% of your equities, 10% of your bonds, replace it with a ETF. Now you've made 10% of room in your portfolio to buy funds like the Bob's funds. And in essence, once you X-ray that, you'll be able to get your equity and bond back, and then add a little 10% on top of the alpha. And then you get 100% of what you wanted and a little bit of that medicine. So very exciting times for diversification, I think, in the public sphere. A lot of exciting stuff with the alpha stuff. I can't wait to see what's coming down the pike for you on the timing of these alphas, Bob. I'm sure that something's percolating there.
Yeah. That's where we're going, is this idea, balanced alpha, tactical alpha, thinking about these things in the context of, the drivers of the alphas. Because that's the thing. This is where we have, I think the managed futures folks have, been the on the cutting edge of this stuff in terms of this idea of indexation and the knowable properties of indexation, creating essentially an asset, a known asset in the way that stocks, in the way that bonds, in the way commodities. But I think the challenge is we haven't done that with things like equity long short and global macro and fixed income strategies and stuff like that. But it's totally possible. It's totally possible to be able to create this sort of indexation. And once you index and you can understand the properties, then that opens a whole world, opens the whole, low cost indexing of beta totally changed the way that we thought about portfolio construction. Think about a world where we can low cost index alphas, right? That is an incredible opportunity. And obviously you could probably tell by my tone what gets me fired up about where things are going.
We're just as fired up as you, Bob. Awesome. What a great episode. Well, thanks, Bob, for your time, on all the macro stuff. Again, just if anybody needs to follow Bob, Twitter, you do an amazing job there of educating the world about how to think about macro, even macro guys that have been talking macro their whole life.
Totally agree. One of the top 2 or 3 accounts on Twitter.
100%.
If you really
I
want
appreciate
what's
that.
going on. Yeah.
At Bob E Unlimited, take his. I think you still have it. Your tweet pinned there of how you taught people at Bridgewater how to think about macro. So I'd recommend people look into that, and also go visit Bob's website, unlimitedetfs.com. All right, with that, I'm going to give you. Thank you for taking so much of your time for us today, Bob. We had a
no problem. I love talking about this stuff, right? So. This is the fun part of
now we're going to hang up and talk about more fun stuff for the next 2 hours, right, Bob? This time we're going to drink up the beer.
Next time, I promise you'll hear more of Richard, who was, uncharacteristically quiet today, but he was crowded out by Rodrigo's enthusiasm today.
I'm not going to say.
All right, guys. Thanks so much. Subscribe.
Have a great weekend, everyone.
Have a great weekend, guys. Thank you.
See you all later. Thanks for having me.
Thanks, Bob.
Stick around, Bob.
This podcast is brought to you by the Resolve Long Horizon Investing Masterclass, a 10-part evergreen podcast series where Adam Butler, Mike Philbrick, and Rodrigo Gordillo of Resolve Asset Management Global explore an advanced investment framework specifically designed to steward quasi-permanent capital with humility and balance. From the science of decision-making to all-weather portfolio construction to the value of diversified alpha and tail protection, this series provides a comprehensive capital management roadmap to improve outcomes for wealthy individuals, advisors, family offices, and institutions managing less than $10 billion. To listen to the series or read the transcripts on demand, please visit investresolve.com/masterclass. Alternatively, you can find it on your favorite podcast player by searching for Resolve-Masterclass.